Hey guys, Lincoln here from boacademy.org. Today I want to talk to you all about SPACs. Special purpose acquisition companies. The companies that are taking private companies public these days, and they're getting more and more popular with retail investors like you and I. We're going to talk about what a SPAC is, why they exist, what their advantages are for private companies who want to go public, what they bring to the table for investors, and why they're so popular today. First, what is a SPAC? A SPAC is a special purpose acquisition company, and its job is literally just to acquire another company. These companies, these shell companies, they have no operations. They are created and they go public just for the sake of acquiring a private company with funds raised from investors like you and I, and of course institutional and accredited investors, people with big pockets and lots of money to invest in big deals. They take those funds, they acquire a private company, and they do a reverse merger with that company to take that company onto the public stock market exchange, where investors of the public can invest in that company. So let's talk about why these SPACs exist. The traditional IPO process, which I've covered in a previous video that you should definitely go and check out, takes a very long time and is very expensive for companies to go through and successfully become public. So these SPACs were created to make the process of becoming a public company much easier, cheaper, and faster for private companies. With a SPAC, the funds to actually complete a public listing already exist because the SPAC sponsors go out and raise the money from investors to complete the merger between the SPAC and a private company. This is not the case for a traditional IPO, because in a traditional IPO, they have to go out and raise that money through an underwriter, and that takes months. They have to go out, create demand, and figure out what the right price is, and then confirm that price with the market. With a SPAC, the demand already exists. The funds are already there in a trust fund. And of course, the private company that becomes public will get the experience of the SPAC's sponsors, the managerial team. The managerial team has experience in the industry that the private company operates in. So they're going to bring that experience to the table for that private company once the merger is complete. The way a SPAC is formed is that an experienced executive or a small team of experienced executives in a specific industry go out and raise money from institutional investors, accredited investors, to create this shell company, promising that they're going to find a great private company that operates in the industry that they're targeting and take them to the public market. And they use those funds to find and complete a merger between that private company and the SPAC and take them onto the public stock exchange. So how much time does a SPAC have to complete a acquisition? Right? They don't have forever. In the United States, they have 2 years to find a acquisition target, and they complete that acquisition via a merger. And of course, they have to get the blessings of the shareholders to complete that merger. So this takes some time. They have to move fast, and they have to be diligent. So at this point, you're probably thinking, okay, Lincoln, I get it. SPACs are cool, they're efficient, they're fast, they're cheap, but why would investors give so much money to one person or a small team to go out and find a private company that these investors don't know about yet? They have no idea which company the SPAC is going to pick. So the answer to that is that investors are hoping that because the managers are so experienced and have great reputations in their industry, they can go out and use that experience to find a great company that has great numbers, sales, revenue, right? They make sense on paper, and then present that company to the investors and say, hey, this is what we found. Do you approve? Can we merge? And if the investors don't like it, they can say no. And if they do like it, they can say, yes, let's do it. Let's complete the merger, take this company public, and let's all get rich. And of course, these deals don't always work out. There is a risk of being burned, right? The sponsors can go out and find a bad company that looks good on paper, And when it gets to the public market, it flops. Investors on the public market may not like it as much as the sponsors and the early investors. As always in investing, there is a chance of these deals falling through. But the sponsors should have the experience to find great companies that will succeed. And that's why investors give so much money to these sponsors to go out there and find such companies to take public. Let's talk about the actual process of the SPAC. So, of course, as you can imagine, finding a great company on the private market can be hard and it can take some time. That's why these SPACs have 2 years to actually do the due diligence, go out there and find companies that make sense for their thesis. So let's take a look at what they go through to actually get to the point of taking a shareholder vote to complete a merger with a private company. So an executive or investor or whoever who has experience in a specific industry creates a shell company with the sole purpose of finding a great private company in that industry to take to the public market, right? Via an acquisition, via a reverse merger. So once they create this special purpose acquisition company, they have to go through the initial public offering, IPO, for themselves before they can go out and find a company to acquire. So they have to go through the traditional IPO process that I cover in another video that is worth watching. It's important to understand what an IPO is when you're investing in the stock market. So the shell company, the SPAC, has to actually go out and go through that IPO process. The IPO process is where they go to raise the funds they're going to need to acquire a private company. So they go out there and they market their deal, their idea, to institutional and accredited investors who have lots of money to participate in these deals in order to complete the IPO. And once the IPO is complete, then public investors have a chance to actually buy into this SPAC that will go out to find a private company to acquire. So the funds from the IPO from shareholders are placed into a trust fund that can only be dispersed in 2 occasions. One, to complete a acquisition, to complete a merger with a private company that the SPAC shareholders have approved for a merger. And the second event is when the SPAC has to shut down because they either couldn't find a private company to take public or shareholders voted down the merger of the company that they found. And this is the worst case for the SPAC, right? Because they have to shut down, they have to liquidate their trust fund and return the funds to the shareholders, which means that the deal is over. So once the IPO is complete, the funds are put into a trust fund. The IPO's managers, the sponsors, now have to go out there to find a private company that the SPAC shareholders will actually want to complete a merger with. Right? And of course, during this process, a private company out there somewhere might be saying, hey, we want to go public. We would love to find a SPAC that would want to take us public because we don't want to go through the traditional IPO process. It would be much easier if we can find a SPAC that fits our needs, right? That makes sense for us, that is in the same industry and has shareholders who are interested in the business that we are running. So once the managers find a private company that they want to take public, they have to announce that to their shareholders. And at this point, they might not have entered into a definitive agreement with that private company to go through and actually complete a merger. They may still have to do their due diligence and then sign that definitive deal. But once that definitive deal is signed by the 2 companies, by the SPAC and the private companies, the SPAC then has to announce to the shareholders when a shareholder vote will take place in order to approve or reject the merger. So when that day comes, the shareholders vote in order to take that private company public. If they like the numbers that were presented to them by the SPAC and the private company, the sales, the revenue, the projections of future growth potential, then the shareholders will most likely approve the deal. But if the shareholders don't like the deal, they don't like the numbers that they've seen from the SPAC and the private company, right? The sales are not big enough. The revenue is not good enough. There's not great margin. There's not great growth potential for this company. Then the shareholders might be inclined to reject the merger, right? And tell the managerial team to go back and find a better company, or if the time is up, they have to shut down. So if the merger is approved by shareholders, the private company is now officially publicly listed on the stock market, right? They are officially a public company that now has to undergo the rigorous regulations of the Securities Exchange Commission, the SEC, right? And they have to act in the best interest of shareholders. So now more investors will be aware of this company and will be able to buy and sell shares of this now public company using their new ticker symbol, because what happens when the merger is complete, the old ticker symbol for the SPAC is retired and a new ticker symbol for the now publicly listed merged company is created, and investors can use that to invest with. And like I said before, if the deal falls through, if the shareholders vote down the merger, the SPAC has to shut down, liquidate their assets, and return the funds to the shareholders. And the managers don't get anything from this because managers don't participate in the liquidation of the trust fund. So managers have a great incentive to complete the merger. And of course, if there is more time, they can go back and find another company to bring to shareholders. And if they're running out of time, they can ask shareholders to approve an extension of their deadline to find a new company and complete a new merger. So in the worst case, if the deal doesn't go through, there's no merger, the SPAC has to shut down and they are no longer listed on the public stock exchange. So let's talk about some examples real quick. In 2016, SPACs raised about $3.4 billion to take 13 private companies to the public market, with the average amount raised per SPAC being about $270 million. In 2017 and 2018, the total amount raised by SPACs was about $10 billion. And then came 2019 to set a whole new record for SPACs. In 2019, 59 SPACs raised about $13.6 billion to take private companies to the public stock exchanges, with $231 million being the average raised per SPAC. That shows that SPACs are growing in popularity, both from institutional investors and retail investors. And one of those companies from 2019 was Virgin Galactic. You know, the space exploration company by Sir Richard Branson of the Virgin Group. And then of course 2020 has come around with all this craziness to increase the popularity of SPACs. We have seen a huge boom in the amount of SPACs that are being listed. We saw back in April DraftKings go public via a SPAC deal. And then we saw back in June Nikola Motors, you know, the competitor to Tesla, going public via a reverse merger with Vector IQ, a SPAC company. With the current times that we're in and the increased difficulties for businesses to go public, we're seeing an increase in the popularity of SPACs. And we're seeing more and more companies opt to go public via this method. And most recently, we've seen a company that I'm invested in, Tattoo Chef, opt to go public via a reverse merger with Forum Merger 2 Corporation, a SPAC company, sometime in Q3 this year. So that deal will soon be complete after a shareholder vote. So that's what a SPAC is. That's what a special purpose acquisition company is in simplest terms. Of course, there is more to it, and we're going to cover that in future videos. So if you enjoyed this video, if you learned something new, and you want more content like this, please push the like button below and subscribe to this channel to help us reach more investors who are interested in this kind of content and want to practice the bull mentality, right? Remember that the bull mentality is that we know what we're investing in, we understand what we invest in, we believe in what we invest in, and we hold for the long term, right? We want to see appreciation in the value of the assets that we buy. So thank you for watching this video. I hope it's been helpful, and I hope you now understand what a SPAC is and why it's so popular.